Hello, and welcome to yet another episode of Decode with Shyam Sekhar. Today's topic is something which divides opinions deeply. Yes, it is active versus passive investing. And we have Shyam with us today, as always, to give us his views. Hi, Shyam.
Hi. So I came down from the hills. The temperature warmed up quite a bit. And now you put me literally in a hot seat on a subject which I am known to have very strong views.
Right,
But
it's almost like an ideological debate, isn't it? Like,
actually, it should not be, in my opinion. See, I am not looking at this ideologically. Where it becomes ideological is when you are only looking at it from a business interest. But I like to wear the investor hat all the time. So I don't have any problem buying an index if it's really worth buying. And if it's going to do good to the portfolio. Whether it's my portfolio or my client's portfolio, it's the same thing. So merit should generally be the driver in investment decision making. The general approach people are taking is that they're trying to say that the active investing as a discipline itself has lost merit. I feel that's a very wrong generalization. Because I am seeing thousands of investors over these 3.5 decades, quite a few of the good ones very closely. Many of them are managers and they've done very well relative to their benchmarks. Styles vary. People follow different styles. Suppose I am a deep value contrarian. In a falling market, if I don't fall more than the market itself, then I know that when my style gets the attention of the market, I will perform. So like that, there could be individual styles of various people, and I can see it when I read a portfolio, which are doing their own thing, which is not essentially aligned to the benchmark. They are investing away from the benchmark. So when people invest away from the benchmark, if you're going to benchmark every month and ask them, why are you not doing well? No? You are not respecting style first. And you're not understanding how that style will work for active investing. And you're not going to end up waiting long enough for the style to work. So these are some of the things which I feel that the critics of active investing are overlooking, not giving enough importance, and making judgments which are reductionist, very hasty and reductionist. As an investor, I would not do it because the final outcome, when it happens well in such a portfolio, it will affect those who went out. Because styles take time. Every style has a certain capacity. For example, in this market, momentum investing won't do well. So, at that time, you probably should stay away from judging it. I'm giving a simple example. For a long time, value investing didn't work for 5 years, but came back with a revenge. So you see today that the returns long term of fund managers who strictly align to value is way above the benchmark. When you look at 10, 15, 20 years, you see that, wow, they've done phenomenally well. But if you see those 4 or 5 years, it wouldn't look like that. I'll give you a simple example. In the flexi cap category, today the largest fund was very value aligned about a decade ago. It struggled. But look at the comeback. And the good thing is the managers who took over also have been broadly value aligned. You had an iconic manager, then you have younger, more dynamic guys who took over, but they've all stuck to the philosophy. So the philosophy leads to performance over very extended periods of time. So if you're going to judge it in short periods, maybe even 3-4 years is a short period actually, when you have a very philosophy aligned product. So the way we judge active investing has to be far more patient. Only if you believe in that philosophy, you can win in active investing. Passive investing has no philosophy. It has no branding. It is commoditized. And it thinks that there is no value to philosophy. If you're a half decent investor, it's very difficult to accept that. Even if you're doing it yourself and you do it decently, I think you will not accept it. It's only those who simply can't do it and have accepted that they can't do it. They readily embrace that philosophy of passives. But a portfolio full of passives will have an investment consequence on the compounding rate of every investor. So,
no, the point here is, Shyam, see, there are so many choices today that investors, or at least fresh investors, new investors, investors who can't go through a downside to see the upside, these kind of investors get very nervous. So passives seem to offer a way out for these investors, and you do have, beginner investors being told that they could start with a portfolio full of passives, or investment advisors advising a lot of these investors to go for a portfolio full of passives. Don't you think when there is confusion over a lot of choice and people don't know whether if you wait out whether that active manager is actually going to give the performance that you are talking about, they wouldn't know, isn't it? In those cases, passive seems to be a good option to take.
An investor not knowing what the outcome will be is something which I can relate to. But if the advisor also doesn't know how the outcome will happen, that is something I find a little difficult to acknowledge or accept. Advisors should know reasonably well as to what the outcome will be. I have been an advisor myself for a very long period. What I have noticed is that young people today are being told to do only passives. And you take the month of March, both active and passive fell almost similarly. It's similar. Mostly when you see falls are happening, broadly it's that the same extent. The fall is similar. But if you're an active investor, you have an opportunity during that fall to do a few investment actions. That is what active investing is. Now, suppose you are going to put money into your portfolio during a month like March. Then that money goes into very specific parts of the market which are more affected than they ought to be by this war. And then when you see those investments revert to mean, the kind of return they make to that portfolio will be definitely higher than what a passive portfolio can give. Practicing active investing correctly during times of volatility will definitely give you a far superior investment outcome than practicing passive investing during the same period. It's how you practice. It's as simple as that. Most people assume that during such a crisis like March, investors won't do anything. That is the assumption which people are bringing into play. But we Indians are value shoppers. In everything, we wait to buy at the right price and to buy during a sale. I think we should do the same thing in our investing also. It's not so difficult. It should come naturally to us. In my opinion, the average Indian psyche is better tuned to active investing. We are not so dumb.
So, do you mean then that there is no upside to passive investing at all? Not for nothing has passive grown, so AUMs in passives grown so much over the last few years, isn't it?
Oh, there is very good upside. In fact, I have used Thematic many times. And once the passives have come, we are quite open to using passive thematics also. For example, if I want to buy US markets, buying a Nasdaq 100 passive is a very good way of participating in that market. It's not that passives are bad. Metals, precious metals, passive is very good. There are very good thematic opportunities in passives. But can you have a portfolio full of such products? I think not. Now, suppose I find 3-4 themes which are very good and passive products are available for them. At best, I can build 20% of my portfolio with those 3-4 things. And that 20% can generate 50% return for me sometimes. I'm quite open to that. I'm not having any ideological opposition to it. But I have to find that, no, it's not as if it's available all the time. Once in 3 years, I'll get one opportunity like that. Now, if I'm going to remain invested philosophically and ideologically aligned to passive in such products, my return won't be the same. My point is, you have to be very specific when you do passive investments. Generalizing is very dangerous. I'll tell you one thing most people are not noticing. In his later years, prior to his passing, John Bogle said that passive investing is at risk, the way it is being practiced. I'm talking about in the West. Whenever we see people, they are all invested only in the S&P 500 or something like that, right? Now, what if there's a long bear market in that country for 10 years? You will just go down with the market, that's all. And you will not come up at all. Whereas an active investor has a chance to protect himself, go to safety, do a lot of things.
True. See, but the point, again, coming back to playing the devil's advocate, the point here is that we do have certain set benchmarks to measure how active managers perform. And these can be in terms of 1, 3 or 5 year time frames. There are set time frames for the industry in which an active fund performance is judged. Now, when you go look at certain categories, there is a lot of underperformance vis-a-vis the benchmark in a lot of active funds. Now, the question arises as to, of course, we all know that expense ratios are also higher for actives because you're paying the fund manager and the rest of the stream. So, when there is underperformance and you have set measures to measure the performance, set parameters to measure the performance, how do you still go and justify active? Ultimately, it can be, as you say, it need not be a philosophical, ideological thing at the end of the day, isn't it? Because you are paying for...
Absolutely. You should get value for what you pay. I don't deny that at all. Yeah. So, let us look at the genesis of how underperformance arises in an active fund. Based on past performance, you give excess capital to a fund at the wrong moment. For example, a fund would have been some 5-10,000 crores. But after it crosses 25,000 crores, it goes to 50,000 crores very fast. Suppose that momentum is with the fund, market momentum. The return in the journey to 50,000 crores will also be good. Then it goes from 50,000 crores higher. At the time, you give too much money. More capital than the fund's capacity. No, this has happened in many small and mid-cap funds. It happened in momentum funds also. So then what happens? The portfolio becomes very, very large and unwieldy, and all the practices, the processes which delivered return at a lower base on a lower AUM stop working. Because when your size becomes bigger and bigger, you won't be able to buy the same companies or companies of the same market capitalization. You have to move up. Automatically, when you move up, finding opportunities become higher. So, you will have to pay a premium to find the right opportunity. So, you overpay. Suppose you are having 80,000 crore and you want to buy a 5% position in a company, you have to put 4,000 crores. How many companies will give you floating stock of 4,000 crore to just one fund? Right? So, all these things become your weakness. Size brings in these compulsions. And wrong timing of giving excess capital becomes a serious drawback for that.
Don't you think fund houses can take this call of shutting the funds? I do remember some of the small cap funds being shut for inflows when, they thought they couldn't deploy capital effectively.
They were still taking SIP. Nobody shut down the SIP. So it's more tokenism. Nobody says no to money. Let's be frank and honest. That's not the point. The point is, misallocation of capital happens not by the manager. It happens at the hands of the investor. He decides to give more money to a manager when the manager also is telling, please don't give me money. Many times you have seen this. He doesn't want to give money to a manager who is underperforming at that time. the next best product or the product that is going to win in the next cycle doesn't get the money at the peak of a cycle. Only the product that has done well in the past cycle gets the maximum money. You know this. And that is true of mutual fund, it's true of PMS, it's true of AIF, it's also true of passives. I'm just telling you. Did you see how much money passives collected in IT ETF? I'll take one specific example. Go and see the pattern in which money was collected around the previous peak. Because everybody thought it's easy to invest based on past performance. Now, whether you are running a tech fund as an active manager or you are running a passive ETF of IT, the outcome will be the same, underperformance. If you compare that performance to, let's say, BSE 500 or Nifty. Right? Why are we simply saying that, that fund manager is useless? Then the passive product is also useless, no comparable product. Right? So, it's we as allocators of capital, as investors, as advisors, as distributors, as very large influencers, we make the mistake of telling people it's okay to invest at any valuation. It's okay to invest at high valuation. Look at this product has done so well. You haven't invested so far. Now is the opportunity to invest. These kind of narratives basically influence even the most discerning investor. And mostly in active funds, I have seen underperformance arises due to giving too much capital at the wrong time to a particular product. After that, the manager struggles.
So it's still a buyer beware industry.
Investing will always be buyer beware. Whether you're doing passive or active, it is not going to change. I think we have to take ownership for our capital allocation. We cannot allocate money to the wrong product at the wrong time. And then blame the manager. He's like a gatekeeper. Suppose there is going to be a tsunami in that sector or in that team. The gates won't hold, and you can't blame the gatekeeper. No. That is the point I'm trying to tell you. Look at, I gave you the example, tech funds, where maximum mistake has happened in recent times. Right? You look at even the micro cap funds, where a lot of excesses happen. Look at small cap, what happened in 2018. Where the manager is wrong. Between 2018 and 2020, by the time COVID came, you had very high underperformance in small cap that became very accentuated post COVID. In the sense, after COVID started, it became even worse, right? From that bottom till now, or till 2024, those 4-year performance, if you see it, more than made up for
the previous.
Because people gave capital at that time. The key thing is to allocate capital at the right time and to avoid allocating capital at the wrong time. That part of active investing is in whose hands? Is it in the manager's hands? It's in our hands as investors, distributors, multiple stakeholders are involved in this. I think that if we are responsible allocators of capital and we give money to the manager when he asks for it. If it's a good manager, we should give him the money when he asks for it. Then he will do well.
Shyam, passive investing is also supposed to be something like an autopilot mode. So where, you don't have, your behavioral aspects don't come in so much. So do you think passive investing will help overcome behavioral flaws which all individuals tend to have?
See, if you're just doing investing, let's say in the Nifty, then and you don't have a second product. Like I heard this argument. Don't buy Nifty. Buy next Nifty. It has the risk of mid cap. This was the argument. What people are saying is that inside large cap, Nifty 50 has a certain risk profile in the portfolio. Next Nifty 50 has a different risk profile. And then what comes after that is actually the mid cap. That is from 101 to 250. What was argued was that similar to the mid-cap risk profile, the next Nifty also carries a higher risk profile. So, by doing more investing into the next Nifty, you automatically get a mid-cap style of risk profile in your portfolio. Now, large cap is something where investing in it should give you peace of mind. In that, you divide it into two. And then you told people, don't invest in Nifty, invest in only next Nifty 50. Now, the volatility in your portfolio went up so much. You have a lot of momentum-based passive products. So, what you're doing is you're taking so much risk in your portfolio and believing that it's not so risky because you're doing it in a passive mode.
Understood.
I felt that most of the people who are doing this didn't understand what they were doing. They were only driven by investing in next 50 and in the mid-cap index in a passive form to reduce that transaction cost, whatever is the TER. But TER differential is what? 50 basis points or 100 basis points. The risk you're putting on the rest of the 99% is crazy. And people are glossing over that. Now, when you do this, you are failing behaviorally. Do you agree with me?
Sure.
So, that cost of behavioral failure is what I think is the biggest weakness of passive investing today in India. I don't think people are going to agree to just invest in the Nifty or just in the NSE or BSE 500. Nobody is going to do that. They want something more. Kuch aur chahiye. People want something more. And whenever they look for this something more, the spice levels in their portfolio is going to go up. Right? And that is going to basically take up their blood pressure, turn them into hypertensives, make them cry while they enjoy that experience or have that experience. They're not going to even enjoy that experience. So these are the things that will eventually alter their behavior, and they may even take out of money even from a passive portfolio. I feel that the interpretation of passive investing in India is nothing short of dangerous from a behavioral standpoint. Oversimplification. Then telling people to do things which don't suit them, which they cannot bear in the long run. And then telling them that passive can be an alternative to active. It's very dangerous. These are two different channels. Suppose you are doing active investing, then you are going to invest regularly and you are going to scale up your portfolio. You are going to buy when others are fearful. You are going to put more capital when money is not coming into that category or asset class. That's active investing, and that should reward you in the long run. Now, passive investing is going to put more money without thinking about which is the right time into the same risky products, which are nothing but a lineup by another name. I think that most people don't understand this. I have seen a lot of passives which I think investors should not have put money into. I'll give you an example. Microcap index.
Yes, I was about to mention that.
Right?
Even the small cap passive index. Yeah.
Even the small cap passive index. Well, I feel that such investing, if somebody is going to justify as better than active investing, the difference between these two is the risk gap. I think people don't understand what they're doing. And I would never do this or want anyone to do this. Why? Because it's not good for them. As simple as that. I am like a person who's telling you that, hey, this is dangerous. Now, if you say, no, I know how to swim. They don't charge me anything for swimming here. Or they charge me too little for swimming here. You are going into the currents.
Yeah.
They are all residents of Chennai. The most foolhardy thing is to go and swim on Marina Beach. Nobody charges you anything for going and swimming in the sea there. But that's not a sea to swim. Right? If you have been in Chennai long enough and a resident who has been 2-3 decades, you know that's too risky, you should not do it. But every other day, somebody or other is going and swimming in that place thinking it's free, accessible, without evaluating the risk. I feel that in passive investing, this is going on too much.
Okay.
That is what I feel should not happen because it's not in the interest of the people who are investing. Anything should be done in a way in which the investor doesn't lose his capital, doesn't lose his confidence, and doesn't lose the compounding experience. Okay. So these three things are not negotiable. I feel that in passive, a lot of things that have happened have only resulted in this kind of an outcome.
Okay.
And the behavior which the investor has shown in this experience is probably worse than what he would have done even in active investing. And what did he save? He didn't pay the manufacturer too much cost, but he has paid the market a very heavy fee. No,
Yeah.
who is to give that? I think if you want to really evaluate cost, there are two fees: fees to manufacturer, fees to market. Okay, fees to market is behavioral fee.
Yeah.
Fees to manufacturer is a management fee. I think just as all of us give importance whether this fee is high or low or optimal, I respect that. I think fees to market should also be calculated. It's not intangible, it's real, it's tangible. And that's what you have seen in all these wrong products where a lot of money went in. I gave you a number of them, and I'm sure there are going to be many more going forward because money travels chasing past performance in passives. And the outcome will be no different from what you get in actives. So, behavior is essentially everything, whether you're doing active or passive. That's the point I want to make.
That was an interesting discussion, isn't it? See you around in another episode of Decode with Shyam Sekhar. Thank you.